Here are two things. One is it's ridiculous, and two is it would be catastrophic. What is your reaction to that saying? How do you take into account the possibility of a U.S. default?
Well, was it Churchill who said the Americans eventually get it right after, and I can't remember the exact quote.
Alternative.
Yeah, so, I'm confident that politics will finally get to the right place on this. I'm confident about that, because the other option is just not an option.
One thing at Davos that people have also been talking about is the new normal for work from home. We heard a bit of a retracement from Citigroup in an interview that David did here with Jane Fraser. What's the new normal? Is it coming into the office 4 days a week? Is it flexible? Is it work from home more freely?
I think it's very, very specific to what you do. If you're a tax attorney who doesn't work with other teams, then obviously you can spend a lot more time by yourself. Doesn't matter if you're in an office or not. I mean, there are different kinds of jobs is where I'd start with. The main point is, post-COVID, we learned you can function. I ran Morgan Stanley for 3 months from my home office, right, with 73,000 people. So it's pretty remarkable. We proved you actually can do it by not going into the office. But should you do it by not going to the office? Now, that clearly, to me, the big answer to that is no. We won't put the genie back in the bottle. 5 days in the office for everybody is not going to happen again. For some people, of course. And at Morgan Stanley, we're kind of business unit by business unit. It's 3 or 4 days in the office. My rule has always been on this: if you're not spending a majority of your working time in the company of your colleagues, you are missing out on mentorship, on development, on EQ, on just reading the signals of being in a meeting and watch how people handle the stresses that go on and the unspoken body language and so on. So it's 3 or 4 days a week. I don't think that changes in a hurry. Some people in some businesses, our trading floors are cheek to jowl. You go in there, they're 5 days a week. So it's very business specific. But my golden rule is, don't put the genie back in the bottle. You can't. On the other hand, this is not an employee choice. They don't get to choose their compensation. They don't get to choose their promotion. They don't get to choose to stay home 5 days a week. I want them with other employees at least 3 or 4 days.
So, James, you've talked about some of the responsibilities of the CEO, which are formidable, allocating capital, making sure you're right there. People sitting around corners. One of the jobs is succession for every good CEO, and we've seen it done well. We've seen it done not so well. A couple of years ago, you said maybe 3 more years. How do you approach the question of succession? How do you set it up for the good of the institution of Morgan Stanley?
Very intentionally. Firstly, you should always have a sort of an envelope for, God forbid, something horrible happens. We've done that from a very first board meeting in January of 2010. But more realistically, you plan a generation of people who can take over. We at Morgan Stanley have now 3 executives who can replace me. They're all very, very talented executives, and we're trying to fill out their skill base, and ultimately the board will decide who is the best qualified to run our particular company at this point in time. I'm extremely intentional about it. I would definitely step down. I'm not going to stay in this job for life. I have no interest in that. And it's unhealthy for our the way we're constructed, right? We've got to focus on what's right for Morgan Stanley, and it's to grow the next generation. I work on a 10-year and 20-year plan in talent planning. And that's how far out I'm thinking about it. And, I've been in this job, this is my 14th year, so I've had plenty of opportunity to develop folks. And the great news is, David, we've got some unbelievable talent.
James Gorman, thank you so much for being with us, the head of Morgan Stanley. Tom, back to you.
Lisa Bramos, thanks so much. I noticed there with the really interesting comments from Mr. Gorman on work from home that Bramo this week is WFD. She is very work from Davos. And we'll have continuing reports here through the end of the week. I should point out David Weston with Wall Street Week. Look for that, a special edition coming from Davos, Switzerland. We'll do that, I believe, tomorrow as well. The world's changed. There was economic data. I've looked at a couple notes while we were listening to Mr. Gorman. Ian Lingen really frames out how unusual claims are. Anyone that tells you they understand initial jobless claims in the United States of America, run as fast as you can, hopefully holding on to your wallet. 190,000 on claims. That is absolutely stunning coming out of this pandemic. Please stay with us through the day. Futures fractionally improved, marginally at a negative 20.
190K, 190,000. Futures negative. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This
Live from New York coming up. Tech results kicking off with Netflix after the close. Jobless claims data in America defying the gloom as the Fed leans harder towards smaller rate hikes. We begin with a big issue. Bonds starting to behave like bonds.
Bonds are going to be your friend.
I definitely like bonds more than stocks.
There is the potential now for bonds to offer diversification benefits.
Inflation is on its way down. The economy is slowing.
Things are slowing down. We're looking at economic data. Very aggressive central bank tightening and quantitative tightening are starting to bite the economy, and they're biting hard.
All of those factors should suggest that high-quality bonds will produce positive returns.
Investors are making the decision, get me into bonds.
One thing about fixed income, and this is the boring part of fixed income, it's the income.
Bonds could be 4 to 7% return this year.
That doesn't happen when yields are close to zero.
It is an environment in which bonds are cheap again.
You get a yield that each day accrues as each day ticks forward.
The attractiveness of bonds going into the rest of 2023 has surged.
Let's start a conversation right now with RB's Mike Contopoulos and Zach Griffiths of Credit Sites. Zach, I want to start with you. 2 points. Bad data, bad news is bad news. Good data, good news is good news. And finally, bonds responding to that news in a way you'd anticipate. Are we making a breakthrough here?
Yeah, John, it's tough to say. I feel like we go from good news is good news to good news is bad news on a day-to-day basis. And when we think about sort of the recent data this week, you definitely saw some softness in retail sales. You're starting to see softness on a consistent basis on the manufacturing side. So that's concerning in a way, but we think it's consistent with the Fed having tightened as much as it has and consistent with a downshift in economic growth in 2023. But we think if the Fed does what we're calling for and hikes just 25 more basis points in February and holds from there, we think we can avoid a recession in 2023, creating a great backdrop for fixed income.
Well, let's start by talking about the data, Mike, and then we can get to how the bond market's responding to it. How bad is this data? Yesterday, I get it, industrial production, retail sales. This morning, jobless claims at 190,000. That does not scream recession, Mike, does it?
It doesn't, Jonathan. I mean, listen, you got to differentiate between the data today versus the data in 6 months, 9 months, 12 months from now. And of course, the market's forward looking. So the market should not be trading on, today's data. I mean, look at, GDP now, for example. I think it's north of 4% at this point, but rather what's going to happen in the back half of 2023 or into 2024. And I think that's what the bond market is telling you, is that the data is okay today, but it's clearly deteriorating and has been for some time. I mean, you have ISM new orders, PMI manufacturing, look at Empire the other day, retail sales, really everything other than labor is certainly weakening. But you got the service side of the economy that's running hot. And that formula of a hot labor market with weak other economic data is the perfect recipe for fixed income, in particular treasuries.
So with that in mind, for the same reasons you like treasuries, Mike, shouldn't you hate credit? What business does high yield credit have rallying into survey data that is showing sub 50 prints on the ISM?
It's pretty ridiculous, Jonathan. I mean, listen, I think there's a lot of technicals going on in the high yield market. You've had next to no issuance, which in and of itself, by the way, is a really bad sign. In our default model, issuance is a big factor into our default model. When you have low issuance, you have huge risk aversion. Risk aversion is usually bad for high yield. But perversely, what's happened is most high yield portfolio managers have high cash balances at the moment. They're not paid to manage cash. They're paid to manage high yield. You've got coupons that are coming due, and you got to put that cash to work, and there's no primary market to do it. So it gets recycled into secondaries, and that ultimately pressures spreads lower. That can only last so long in the face of deteriorating economic data. deteriorating fundamental on the corporate side. Listen, we're about to enter into an earnings recession. Low quality never does well in an earnings recession. So the whole "this time is different" argument, I think, is not going to hold a lot of water. As defaults start to increase, as liquidity remains tight, as you go into an earnings recession, I don't care what the technicals are, spreads are going to widen. But by the way, Jonathan, everybody loves IG. We don't like that either.
Mike, I can see it in your notes. You said this: why would anyone take credit risk here? So build on that. It's not just high yield, it's IG as well.
Yeah, I mean, listen, I think probably the most consensus fixed income trade out there is investment grade credit. You look at spreads on investment grade, you know, you can own the investment grade market at about now under 5%, or I can own a 2-year treasury at about 4%. You know, give or take on any given day, it's a 50 basis point difference. Why would you take liquidity and credit risk going into an earnings recession when I can get lower duration, you know, same yield paper and treasuries? It makes absolutely zero sense to us. And so we really don't like credit here. We think there will be a time, by the way, to own credit, Jonathan. And the fundamentals are not terrible. I mean, balance sheets are relatively healthy, but now is not that time. You need to be compensated for liquidity risk. You need to be compensated for default risk. And in the investment grade side, you need to be compensated for downgrade risk and business risk in general. And so far, you're not.
Zach, it's in your title. Investment grade. This is your world. What do you say back to that?
We're taking the other side of Michael's view, and certainly appreciate that yields have come down a bit. But when you think about the reinvestment risk of owning a 2-year treasury versus the duration of the IG index closer to 6 or 7, something like that, I think that factors into it. And while he did mention some technical concerns, I think that there is a lot of cash out there looking for a home. We don't have as negative an outlook on economic growth or earnings as Michael seems to have. And so we think that really the income that you can earn now relative to what you've gotten in the past makes IG attractive. And we think high yield is even more attractive. Again, yields have come in quite a bit. We think the fundamental backdrop is solid. And even with a downshift, when you look at the supply and demand dynamics, demand is really coming back from the retail side. You've seen that in the first couple weeks of this year. We think that has some staying power, while at the same time, the maturity wall in high yield world isn't a concern, I'd say, in the first half or maybe in 2023 overall. So if markets can remain as open as they've been over the past couple of weeks, we think both IG and high yield will perform well this year.
Mike, have you got to come back to that?
Well, you know I do, Jonathan. On the high yield side, maturity walls never matter. You look back in 08, 09, as defaults were skyrocketing, the maturity wall was actually pushed out quite far. And so if you go back and look at, you know, prior default periods, the maturity walls don't matter. You miss your coupon before you ultimately have to refi your debt and default that way. But listen, more importantly, you know, I prefer long duration, long maturity treasuries. If you think there's any spread widening potential in investment grade credit, then you would rather own treasuries because you're not getting enough of a yield cushion to make up for any spread widening, really. So, you know, much of this, I think, comes down to, you know, who you are as a portfolio manager. What kind of strategies do you manage? If you're an investment grade bond manager or credit manager, then certainly today doesn't look bad to own corporate credit risk. If you can be a multi-asset fixed income manager, to me, you know, long maturity treasuries without the spread widening risk makes a lot more sense and can give you equity-like returns.
The Treasury yields this morning on a 10-year up 2 basis points to 339. I'm not trying to start a fight over credit. That would be pretty lame. Equity futures right now down 0.7% on the S&P. Mike McKee's dropped by the studio to catch up with us as well. Mike, before we get to the Fed speak, can we just start with the economic data? Softer yesterday. And then can you please make sense of this? Jobless claims, I'll keep saying it, 190,000.
I guess I fail because I can't make sense of it. The only thing I can possibly think of is that there is a seasonal distortion. It's January when a lot of companies traditionally lay off the extra workers they hired for the holidays. And there does seem to be no real effort to lay off extra workers these days in a lot of industries. We saw that in the Beige Book yesterday. You mentioned the numbers, and the headline, of course, the one that got everybody's attention, jobless claims 190,000. We did see a decline in housing starts and building permits, and you look at the total number there for the year. year. It's down 3%. It's the first year of a decline in housing starts for some time. Philadelphia Fed is also interesting, not just because of the negative 8.9, which is actually an improvement, but 24.5, extremely low for prices paid, and it looks like inflation is starting to fall, which leads us to the debate here that you guys are having and that everybody on Wall Street's having, the second derivative of what does it all mean to the Fed. On the stop side, inflation is falling. Job growth is slowing. Retail sales yesterday, very weak, and we've got this inverted yield curve that just keeps getting worse. But on the don't stop side, inflation's still too high. Unemployment is falling. Wages are rising too fast. And the key thing is this 1980 argument that the Fed stopped too soon in 1980. Inflation went back up and we had another recession. Jamie Dimon this morning saying he thinks the Fed is going to go over 5%. They still need to do a lot more, which leaves us with the fight between the Fed and the markets. That has not changed as of this morning, with Fed officials still clinging to the idea they're going to go over 5%. Susan Collins of the Boston Fed just seconds ago out with comments that they need to get over 5. They can do it slowly. She's in the 25 basis point camp, but they need to be more restrictive. And then the question is, where do they end up? They say they hold. The markets say they cut.
Yeah.
It's going to be an interesting debate over the next few months.
The pace of the journey for them.
Hey everybody, welcome to Trading Capital's daily live stream of the market open. So right away we can see that the markets are down in the pre-market. Markets opened down sharply lower, even ahead of all of the economic data. So today we saw initial job loss claims come in better than expected. Obviously good news is really bad news in this environment because it's still showing a very, very tight labor market, which gives the Federal Reserve the ability to continue to raise rates. We also had some housing starts come in, as well as a couple other data points, but overall yields are up. The dollar is flat right now on the session, so we have to really continue to watch the yield market and the dollar market. But markets down even after a big down day, and there's certainly weakness in a couple large big names like Procter & Gamble, Apple, Amazon. So definitely weakness across the board. Procter & Gamble did report earnings. They beat on earnings. They're down in the after hours, but they've had a significant bounce off the lows. And then we also had Alcoa, which is down on the session in the pre-market. So a couple plays on the radar. I'm just going to scan through to try to isolate down some levels. I'm going to go silent on the mic for the next 5 to 10 minutes. And then I will bring you in, give you a little bit of an update in terms of what stocks we're watching today for potential day trade, either shorts or longs. It's looking like, since we have a gap down, that the plays are most likely going to be probably to the downside or probably to the long side. And then if markets get a little bit of a sustainable bounce, then we could potentially look to incorporate a trading short. So stay tuned. I'm just going to go silent while I analyze and scan some charts, and we'll be with you in a few minutes.
Very quick shift to rate cuts. We know the Fed has said that's not their plan. They've said it over and over again. The market hasn't budged. So we think lower terminal rate, staying there for longer, and inflation coming down more quickly than perhaps is appreciated by broader market sentiment at this point.
It's January 19th, and I think the consensus has shifted twice already in the last couple of weeks. Neil Dutcher of Renmac pointing that out. Neil published just moments ago. He said in less than a week, financial market participants have gone from increasing odds of a soft landing to increasing odds of an imminent recession. Sorry, but the economy simply does not work this way. This is where Neil was at in the last 24 hours. And Mike, I'd love your view on this. This is what Neil's got to say. It's a more constructive, optimistic view on things. He said the manufacturing data were undeniably weak. But why does this continue? Aircraft and autos have a lot of momentum. The dollar's sold off, supporting the exports of manufactured goods, and global growth has rebounded. Mike, a final word on that, please.
Yeah, I think, listen, at the end of the day, it is very difficult to see an economy that's going to continue to, or I should say, expand from where we are today, given that rates are restrictive, You saw what's going on with banks. You know that lending standards are the tightest they've been since the global financial crisis. That's not an environment, especially as you go into an earnings recession, where growth re-accelerates. And so from my perspective, I'm not, terribly bearish on the economy. Like I said earlier, the economy's doing okay right now. But, if Zach's right and you got 1.5% real Fed funds rate in 6 months' time, that's pretty restrictive policy in the context of an already slowing economy. It doesn't look good.
We'll keep building on this. Mike, Zach, you're going to stick with us. Equities down about 0.8%. Hearing from the Boston Fed President Susan Collins this morning saying the following: remains optimistic about a soft landing and the odds-off one. Says the slower pace of rate increases is appropriate. This is about risk management now for some of these Fed officials. She says a more measured rate hike and that address of a more measured hike from, say, 50 to 25 would help address competing risks. That from the Boston Fed President, Susan Collins. A little bit later, you're going to hear from the Vice Chair of the Fed. You're going to hear from Lael Brainerd. You'll also hear from the New York Fed President, Mr. Williams, as well. All of that this afternoon. Coming up, corporate America, running costs.
These cuts help us drive greater efficiency, help us size the footprint. We think we're safe, but we will continue to adapt to the environment as it unfolds.
During the pandemic, there was rapid acceleration. I think we are going to go through a phase today where there is going to be some amount of normalization of that demand. Quite frankly, we in the tech industry will also have to get efficient, right? It's not about everyone else doing more with less. We will have to do more with less. So we will have to show our own productivity gains with our own sort of technology.
Layoffs piling up from coast to coast. Two of the world's largest tech companies, Microsoft and Amazon, cutting 28,000 jobs this week. Cost-cutting measures making their way to Wall Street as well. Bank of America, the latest to hit the brakes. CEO Brian Moynihan saying, quote, "We were hiring to match the Great Resignation earlier in the year, and it was sort of overachieving." Shnali Basak on top of this story. Shnali, a key feature of earnings over the last week or so.
A key feature is those costs just ballooning. And remember, simply said, John, the pie is getting smaller. There's a bar on how high revenue can get. And you have headcount at Bank of America alone, which is causing a hiring freeze right now, headcount ballooning by 8,500 last year. Remember, wages are also rising here. All in all, this means the big six banks are expected to spend a record amount of money this year, $320 billion, 2/3 of that coming from labor costs, personnel expenses, compensation. Remember, technology spend is also higher on the year for many of these firms. So they're going to have to make a trade-off on these long-term investments they make versus the personnel moves they make this year as they hope to get out of a slumping market in some of these businesses. Now remember, this really just takes you back to where you were maybe a year ago at some of these firms. So even though the thousands look very dramatic, this is after many years of boom times. So that's why it feels so hard right now. Remember, even at the mass tech layoffs, it really only brings you back to around pandemic levels because of how much the headcount has ballooned. But with tech not hiring as much, with the layoffs in the tech industry, the competition starts to get stiff for where a talent can go next, which is why you're seeing Bank of America say something like that attrition has just slowed down. There's nowhere to go next.
Shanali, thank you. Looking forward to your coverage of this story in the year ahead. Mike and Zach back with us for a final thought. Mike, it's amazing, isn't it? On the one hand, we're talking about jobless claims at 190,000, and then we've got example of example after example across a range of industries saying things are getting bad and the cuts are coming. Which one is it?
Well, I think you're going to see the weakest link break first, and tech effectively is the weakest link. I mean, what a lot of people forget is that tech companies are cyclical. And as the economy starts to slow, and more importantly, as earnings growth starts to slow, that's going to hit tech, just like it would any other cyclical. And they overbuilt during the pandemic. And so it's no surprise to us to see tech, really starting to weaken and start to see the layoffs there. Just like in credit, where, the weakest links tend to go first before it works its way up the stack. You're going to see the same thing in the labor market. Remember, labor is always the last shoe to drop, and I think that's what explains jobless claims. It's going to take some time. The labor market is strong, and this is just the beginning of what we think is going to be a weaker employment picture throughout the year. It's not going to be a quick 1 or 2 month scenario. It's going to be a 12 to 24 month scenario.
Bob Michael at JP Morgan, speaking to our colleagues at Bloomberg News earlier this week, he made it quite simple, Zach. He said the equation is this: inflation doesn't come down until wages do. Wages don't come down until employment rises. Unemployment doesn't rise until we're in a recession. Zach, is it that simple?
I think the logic is there, but I think we're going to see the unemployment rate start to rise before we're in a recession, and we've had an extremely brief cycle on the way down and on the way up. So I think that it's hard to use historic norms to kind of trace or map exactly how that's all going to play out. We think the unemployment rate has to rise from here. You're starting to see signs of that with these layoffs, and I feel like that's gotten more prominent over the past couple of weeks, past couple of months. It really hasn't shown up in the data yet. We think that's in the pipeline. And the Fed has emphasized how much the labor market needs to come in much more balance in early 2023 as they assess whether or not they can pause policy. So we think that's going to become a very important indicator, as it always has been, perhaps even more so as the Fed assesses where policy is going in 2023.
Isn't that the US risk question, though, right now, Zach? Do you want to be long credit risk, high yield, into an environment where unemployment's going to be climbing and not falling?
Historically, it's been a difficult situation to be long in that, but we think that when you look at yields and the type of income you can generate from fixed income, on top of the fact that there still is a lot of cash out there on the sidelines, we think have been kind of sidelined due to all of the macro uncertainty, all of the policy rate uncertainty. We think that continues to come into the market in 2023 as investors were certainly hit hard in 2022, but came into the year more or less on sides, understanding that duration was not the place to be, credit was not the place to be. There was almost nowhere to hide. So we do think you're seeing that in the first couple of weeks of this year, reinvigorated investors with cash to put to work at much better yields, which really is the backdrop of our constructive outlook.
The year of fixed income, I've been told several times. We'll work out which bonds by year end, I guess. Mike Contopoulos there and Zach Griffiths. We'll find out who was right ultimately. Equity futures right now down 0.75%. Fantastic panel to kick off the show this morning. Coming up on the programme, the morning calls, and later, Edward Jones shifting its attention to international equities. We'll catch up with Mona Mahajan around the opening bell. The opening bell about 7 minutes away.
Hey everybody, so welcome back. We're about 6 minutes till opening. Right now you are seeing the S&P rally off of the pre-market lows, but it's still down on the session. The only real play that we're looking at is Alcoa this morning. Now there could be other opportunities as things present themselves, but right now Alcoa, if Alcoa can get a flush down to really this 48.90 or a pierce of 49, that might be a potential day trade level. The bigger levels though are these two green lines down here, but we could keep an eye on Alcoa. Spiders you can see that have gapped over this gap over here, so there's likely potential that we float up and retrace to that area, fill the gap before we slowly start to trend lower. But the spiders are at support. There's no trade right now because we are seeing some weakness continue in banks. Apple's trying to rally up, Tesla's trying to rally up in the pre-market. Semiconductors still remaining weak, so we have to keep an eye on that. So we're just going to be patient. I think what we're going to probably see is a float up in the market since we gapped lower. But let's just monitor the price action and be patient. Let levels come to us, and that's primarily how we're going to trade today. Procter & Gamble is potentially another play. Let me just do some work here. So Procter & Gamble would have to come back down to this 140 level. That was the pre-market lows. And I want to see it fill that gap. About 140. Let's take a look at Discovery Financial. DFS is down on earnings. Down substantially. So we have a few minutes left to market open. So we're just going to keep a few stocks on the radar. Procter & Gamble needs to revisit the lows. DFS.
One option is Lowe's on Gardner's Road. Is that?
I guess Siri has a mind of her own this morning, trying to come in and listen to our trades here. So markets are about to open in 1 minute. We have Procter on our radar. We have DFS. Procter has to go back down to the pre-market lows around 140, so it's still about $3 off that area. DFS, I would like to see it pierce this white line, so pierce of 93. So let's just see how things are going to transpire. Good day trading support will be on the spiders at around 386. 386. And then even a bigger support here at 385. So the markets are opening. Markets are just about to open in a few seconds. So the markets are open. The spiders are seeing continued selling. An initial sell, but we likely see a float up.
8 percentage points of gains over that period, and then we snapped it yesterday. Futures lower again today on the S&P by 0.6%.
Procter looks like it wants to come down. DFS catching a bounce. Alcoa not catching too much of a bounce yet. Spiders are rallying though.
What recession? 190,000 yields up 2 or 3 basis points on a 10-year. 339.87 on a 10-year.
The spiders are still rallying.
Dropped hard across the curve.
We're just waiting patiently.
433, 434 was the intraday high.
Nvidia is rallying, so that should give the markets a boost as semis come off the lows. Tesla's filling a major gap. Apple's about to approach a gap fill. So you are seeing some strength. The spiders are trying to rally, but there's still some weakness in the financials. Procter's still coming down. DFS catching a bounce, so no trades as we speak. Let's just be patient. See if anything hits our radar.
Also, one stock to watch at the open, Procter & Gamble, sales falling across categories as consumers grew more cautious amid higher prices. The CEO said this: it was a very difficult cost.
So the dollar is down.
Environment. Kelly Line says more. Hey, Kelly.
Hey, John, yeah, this is an interesting one because actually
yields are up though, but pulled back off of the highs. Gold's trading up on the session. Spiders are pushing. So we'll see if it retraces to this gap. That was supposed to be support. And we will see if we touch that area. It's very likely we do, but Nvidia is seeing some distribution. Procter & Gamble is catching a bounce. Spiders are seeing a little bit of sell pressure coming in off of that rally. So semiconductors are weak. We're really keeping an eye on Nvidia and the likes of those names because they are very, very important. Bitcoin's really just flat. We're still seeing weakness in the financials. Alcoa is catching a bounce. Spiders are getting a nice rally here. So you're actually seeing some weakness in the Dow components. Things like Caterpillar, Apple, but Apple's filling a technical gap here. It is a potential very aggressive short trade on Apple, a very aggressive short trade on Apple. Oops, let me just get that credit. So Apple's filling that gap as we speak. But markets still look vulnerable, to be honest. Even though the spiders are rallying, markets still look very vulnerable. So there's a daily gap on Apple right there, which it is an aggressive short. So just be careful and mindful of that. It's an aggressive short trade, but it is potentially one that could pay off, as you do have a secondary factor of resistance down sloping here, which could act as your buffer. So Apple's remaining strong. Let's just see if we can let a trade fall in our lap. We don't want to do anything too crazy. So the spiders are continuing to push. And the big Netflix is reporting earnings today, so we'll have to obviously monitor that.
prices on the S&P right now, down 0.4% on the S&P 500. Evercore's Julian Emmanuel had this to say a little bit earlier this morning.
So
He said
far,
the
markets are just really floating up a little bit on the session.
The deterioration is unfolding against the backdrop.
Apple's now filled its gap, or almost.
Ever bottomed before the start of a recession. That line right there.
Still weakness in JP Morgan, Caterpillar, some of the Dow components. Dow transports are down. So the Dow transports down on the session are a little bit of a negative indicator for this market. Typically when transports are down, it means the rest of the market will follow later on. So let's see if the markets sell. If we get an initial short covering here, potential sell, you can see Apple's pulling off. SPY is now trading back lower. So let's just keep an eye out on here because transports are weak and so are the semiconductors. Semiconductors are really look to be struggling at this point in time. Apple's pulling off the highs, so is Tesla. XLK is down across the board. UAL is coming in nicely. So you're seeing some strength in energy with oil up on the session. Exxon's catching a little bit of a bid.
Concluding its hiking cycle, and the European
so now you could be seeing a little mini pop in the dollar. Let's check out this DFS reversing. Alcoa, still no trade there because it was down more in pre-market. But let's be patient. Let's be patient. Markets are continuing.
There is an opportunity even to look beyond the EFA, but think about the emerging market opportunity re-emerging. Now, keep in mind, this is also dependent on us getting through this potentially global downturn, re-emerging in a pattern of better global growth overall.
Mona, can you tell me what you mean when you say EM?
So the dollar's trying to put in a potential little bottoming tail, intraday low. It would be an intraday low bottoming tail, which is actually a little bit more bullish for the dollar. Still seeing weakness in the XLF.
It is a lot of the Asian economies, but Europe is a large trading partner with China as well. And so anytime China strengthens, which we do think it will in the year ahead, it benefits the entire region in that area. And so we think EM is a collective of the emerging economies, but particularly...
So we're going to watch DFS here. Let's see if we can get a bounce on DFS. A pierce of this 93.73. A pierce of this 93.73 will play DFS long. The dollar's pushing up, so it's likely we're going to get to play this. Just be patient. Let's just be slightly patient. The spiders are trying to push up a little bit. So a pierce of this 93.73 area, we can go along. A pierce, and it'll be a 1/5 position.
Areas like industrials, like energy, parts of financials are tremendous parts of the economy in Europe. And if we think a value story has some legs over the next year and years ahead, Europe is an interesting...
93.73 is the level. Just scrolling through, seeing if there's any other potential plays.
In their banking system, they do have an overhang. They've been facing the slower growth, lower inflation environment for years ahead of the last 12 months. And so generally speaking, we think a trade is in place, but the longer term story...
Apple's still remaining near the highs.
At the index level,
Still have weakness in the financials. So this is where this gets a little bit tricky, this DFS, because there's weakness across the financials, which means that there's likely going to be continued weakness in this name. Spiders are still remaining near the highs. Apple's now filled its gap to the upside, I believe. Let's just check. Almost. Gold's remaining up. Yields are remaining up on the session. Dollar is still currently down.
That there is a better opportunity for more balance between value and growth. Now, does growth have a period of maybe a bounce back?
Still waiting on this potential DFS. Apple is pushing up sharply now.
Longer term, we do think that balance is important. And so to your point, from an index perspective, perhaps, having a bit more value in your portfolios makes sense.
Yep.
But certainly having the U.S. With a balanced index is also beneficial.
In the short to medium term, I am wondering what rates.
Apple's
and lower
remaining
rates
strong,
means.
pushing up. S&P's pushing up as well. If Apple hits the top of this trend line in a straight shot, I'm going to short a 1/5 position. So Apple's pulling back now. DFS is remaining off our level. Let's flip back to the spiders. So SPY.
Potentially globally, to come back to the forefront. And so that includes not only defensives, but
so we're going to skip DFS now because it's had a big bounce. Flip back to the spiders. China stocks are acting fairly well, acting very strong today.
So we have to make sure as investors we're using those opportunities. As you position for a recovery playbook, that's when you want to start thinking about things like quality growth, cyclical parts of the market, longer duration parts of the market generally. And so we do think in the next
S&P is pushing back up now. It's looking like it wants to attack that gap fill.
Mona, we're just not there yet in the minds of many people. Mona Mahajan there of Edward Jones. Mona, thank you as always. Third day of losses on the S&P. We're down about 0.4%. Coming up, Netflix earnings providing the first read into big tech.
With the exception of Netflix, everybody is losing a lot of money.
That conversation still ahead with Michael Nathanson of MoffettNathanson.
So we're seeing the spiders pull off the highs. Still no trades for us. Nvidia is still acting weak. Spiders are now pulling off of the highs. The dollar did put in an intraday 10-minute bottoming tail, so let's just keep an eye on that. You're still seeing continued weakness in Costco, Walmart, so basically the consumer staples. Seeing continued weakness in some of the leaders like Merck, Honeywell, some Dow components there. S&P is coming down now. I'm covering my UAL short. 47.20. That is a profit of 8.5%. So we covered our UAL there. UAL short. That was a swing trade with the members. So a beautiful 8.5%. Spiders are coming in harder now, so let's just see what transpires here. Nvidia is going weakening. You can see the spiders are giving up most of its gains. So if we get a flush on the spiders, we can play the S&P for a long. I would much prefer that outcome. right now, considering we did do a gap lower. But the sell could turn nastier if you start seeing a lot of these stocks turn more negative. Which is certainly shaping up that way. The VIX is creeping up. So we're seeing the S&P still coming in, remaining near the lows of the session. Take a look at Apple. This is turning into a nasty sell potentially. A nasty, nasty sell. So now where things are going to get interesting. This is where more opportunities arise for us, believe it or not. Spiders are making new lows. So you have a tremendous amount of weakness. You're still seeing incredible weakness. Good sell-off coming in on the S&P 500. Here we go. So this is why we're net short the market, and we are crushing it today over the last couple days. But we're now in a position So we just covered our Kellogg short as well for a lovely 8.5%, I believe. 8.78%. China stocks are showing great strength today. Great strength across China. We're seeing weakness in copper stocks. That's awesome for our short trades there. So the markets are still seeing continued weakness. S&P is still making new lows, but just slightly on the session.
As well for some of these streaming players. Tell me what you're expecting a little bit later this afternoon.
Okay, we're expecting, as I said, currency is a big tailwind here. They have, all their programming costs, majority of their programming costs are in the U.S. So as the dollar weakens, they really benefit from weakening dollar. So we'll hear about that. You'll hear about, we think, an inline quarter on subscribers, but they're going to spend time talking about password sharing crackdown, right? They've said they're going to talk about their plans to stop people from sharing passwords. And then you'll get some updates on advertising. I still think advertising is early days. Our view is the stock's a bit ahead of itself here. But I think this has become a story stock around password sharing, advertising, and then, what we're saying is a third act of streaming where you'll start to see consolidation within media, companies of spending less money on streaming. There has to be some rationalization.
Creep in. Market weakness is creeping in. The dollar's popping tremendously, so that's going to put additional pressure. We should see energy stocks respond negatively. Nvidia is having a hard dump, so now there actually might be a play on Nvidia. Let's take a look at NVDA. It's coming in substantially harder. PNC is another one. Sorry, we just have so many good levels potentially here that are being tagged at this moment in time. Look at this dump on Nvidia. That's a thing of beauty. That's a thing of beauty on Nvidia. Let me just see if I can isolate down a level on Nvidia, but these markets are remaining terribly weak. The dollar's popping still. Dollar is popping.
We've always been doubters, right? Like we've always been asking people, saying the same question: is streaming a good business? When people say Netflix has made a lot of money, they've only had free cash flow.
Spiders are going lower. Dollar's surging. This is getting nasty, people. This is getting nasty. Wow. This is a moment where if the sell-off continues hard, especially if this dollar goes positive, you do not want to jump in front of this. But there's going to be some opportunities here. I mean, even just this Nvidia trade, I'm eyeing up a potential level as we speak around this 165 area. Tiny bounce for the S&P. If we get another little touch of this trend line at the 148.44 level for PNC Financial, then we can play along. PNC is the ticker, 148.44, but we need it to hit in the next 9 minutes. Nvidia is catching a bounce. Still seeing continued strength in China. Alcoa's had a pretty impressive bounce. Energy stocks still remain strong.
We've been saying for the past 2 years that we see penetration as peaking in Western Europe and North America.
I've been complaining about this for a while. You and I have been talking about it. It just feels like this has quickly become the old cable story, Michael, that everyone complained about, and now they've ended up with something that looks like the old cable story where we're still spending too much money on content.
And you would say, Jonathan, as a consumer, it's suboptimal because you have to go in and out of different apps.
Drives me nuts.
Yeah, it drives you nuts. And I heard the conversation about Harry and Meghan. I started 2 episodes. I kind of forgot about it, and it's kind of lost in my, within my catalog of things I want to watch.
I'm gonna grab some PNC Financial here. PNC 1/6 position. I'll tell you when I get filled. Ah, they're bouncing it before. I wanted it sub 149. It might come back down. It might come back down. I don't want it above 149. I'm going to cancel my order because it's getting a bounce now. So taking that play off the table. Basically where I want it now is at this wick low. So let's put a little bit of a alert there. Nvidia's caught a bounce. Let's check back on the SPY.
I'm arguing that in 2021...
Still seeing weakness in this market creeping in.
22 is laughing that. You will have economic risk and probably risk numbers in 2023, but the multiples have come back so
Markets
much.
are still trending lower. You have weakness in some of the leaders like Caterpillar, down substantially.
It's a comp issue from 21. So that is the heart of it, right? And I think they've all pivoted to try to take on TikTok, and that's hurt them on the revenue side. And I think you'll start seeing...
Spiders are still remaining very, very weak here on the session. Take a look at Nvidia. Nvidia's down tremendously. Spiders are trying to perk up a little bit. Dollar's perking up. It's trying to go positive on the session. Down 12 cents on the session. But if you see the dollar go positive, we could see this market even break lower. Really nothing that's jumping off of the radar here. Again, the markets are very, very vulnerable. PNC is piercing that level, but I don't want it because the market is rolling over and the dollar is surging. So next level on PNC. Spiders are selling a little bit harder now. Nvidia we can play at this 165.76 level, assuming it has a straight shot in there. Let's see if we can get a decent bounce on this PNC. I'm going to pick up some PNC here, just letting it pierce. I'm picking up some PNC here. I'm long PNC. I'll tell you, I've got 147.93, 1/6 position, 147.93. 1/6 position on PNC. $147.93. So we're going to need the financials to uptick a little bit here. 147.93. Markets are still selling. Markets are still selling. The dollar remains strong. So the next add level would be 147.33. 147.33. But we haven't added yet. Catching a little bit of a bounce here. So let's see if we can get this. We're in the money now on PNC, slightly. Financials are still remaining weak. But we could probably try to squeeze $1 out of this trade. $1 on this trade would be a good target. We're in the money a few cents now. Nice bounce on PNC. Here we go. I'm looking for $1. It's about 148.83. Sorry, Markets are beginning to float, so this is potentially good for our trade here. We are long. We are long. PNC trying to catch a little bit of a bounce here. Let's see if we can get a little bit more action. Here comes PNC, so we're in the money. Good little pop coming in. Apple's trying to push to the high, so the markets are getting a nice little pop here. Markets are getting a nice little pop. Dollars coming